Great. Well, thank you everybody for joining today's webinar. Stay the course, managing variable life insurance in a choppy market. Given the recent market volatility, we've had several clients reach out to us the last few months just with a lot of questions on the variable life insurance policies that they're managing. So we thought this would be a timely topic today. I'd like to introduce everybody to Trusted University. Trusted University stands as a collaborative resource where financial advisors, estate planning attorneys, and trustees can access valuable insights and educational content, all designed to foster the professional growth and elevate industry knowledge. While ITM and Life Insurance Trust Company primarily focus on life insurance trusts and unique assets, we will have broader educational topics outside of that area. Our next webinar is scheduled on June 17th, where we'll be discussing the advantages of South Dakota trust law. Register for free at learnwithtrusted.com. The speakers today, I got some announcements and reminders. Please, we will have a short survey after this 30-minute or so webinar, so please take a quick minute to add any feedback you'd like to have after the webinar. Within 24 hours, you will receive a link to the recorded event. You will also receive the presentation materials and the ability to request a certificate of completion where you can request your CE credits. The speakers today, I have Tony McKillip. He's president of Life Insurance Trust Company, or LITCO by short. LITCO today manages over 5,000 irrevocable life insurance trusts. They are the largest corporate trustee in the country managing ILITs. Their whole focus is ILITs. They don't offer any other wealth management services. With me also, I have Eric Scow, Director of Operations of ITM. He is a chartered financial analyst. He also heads up our registered investment advisor here, which is used to analyze the sub-account allocations for variable policies and offer recommendations for those clients that sign up for those services. The agenda today, we did have an attendee ask for just a broad overview to get started with. So we're going to have Tony cover the history and mechanics of variable life insurance. And then Eric will dive into some of the challenges that trustees face managing these policies and provide kind of an annual review and asset allocation process to give you guidance. Lastly, we should have time for Q&A. So with that said, I will hand things over to Tony to talk about variable life insurance.
Thank you, Greg. Just a little bit of the history and mechanics of variable life insurance. And I think it's important just to kind of understand how variable policies came about. You know, a little bit of the evolution of life insurance policies. You know, we really started off, carriers started off with, you know, really meeting the needs of the clients and designing products to meet challenging market conditions. You know, at first we had carriers just offered term insurance, you know, probably one of the simplest and easiest to understand. You pay a premium and for a upcoming year as an example, and you're covered for that year. It wasn't permanent, and out of a response to get a more permanent coverage for life, carriers offered a whole life policies. These whole life policies provide a guaranteed death benefit and cash value if the premiums are paid in full each year. In addition, participating whole life policies also offer additional cash value through dividends. These dividends can be used to pay the premium, purchase paid up additions. You can take them in cash, or you can repay these any loans on the policies. In response to short-term interest rates skyrocketing in the late 70s and early 80s, carriers developed a way to take advantage of these high interest rates and the tax deferrals within insurance policy products. These policies are known as current assumption universal life policies, and they were sold on current interest rate assumptions and charges at the time of the sale. When interest rates began to fall, many of these policies were underfunded and needed additional premiums or lapsed as a result. These products also offered more flexible premiums. In response to interest rates falling, many carriers started to look at a way to avoid some of this market interest rate risk. So they began to offer guaranteed universal products. And while this took away the flexibility of the premium, it did require these premiums to be paid on time every year in order to maintain those guarantees. On the flip side of that, you had a guaranteed death benefit for a specified period of time. To take advantage of some of the equity markets and good runs we had in the mid 80s through really the 2000s there, carriers began to offer what are known as variable universal life, which is the main focus today. And these utilize underlying equities that can offer a greater rate of return. Everything in the side of the policy grows tax deferred, and can actually get a little bit higher death benefit and takes advantage of the equity markets. In response to market crashes and volatility in the markets, a lot of carriers began to offer what are known as index universal life, and these typically have a floor, and some of the upside is capped, but they follow an index such as the S&P 500. On the next slide there, I just wanted to talk a little bit about, who's responsible for the investments and how the cash value type works inside of these policies. So in a traditional universal life and whole life policies, this cash value is fixed. Assets and cash values invested by the carrier. An index universal policy, this is going to be purchased, follow the index, and a lot of times though the carrier will give you an option to which index you're going to follow, and they do have a floor and cap. Typically the floor would be 0, so you can't do worse than that, but they also a lot of times cap the upside on those. And then variable universal offers separate sub-accounts, and the big difference here is the policy owner, and in most cases, especially if it's trust owned, it's going to be the trustee is responsible for choosing those funds, choosing the investments. You're responsible, you're driving the ship on those rates of returns. On the next slide here, just some of the mechanics of the universal life policy. And this would apply to index universal, traditional universal, and variable universal policies. A lot of times we can think of it as a bucket. Think of a water going in to fill up a bucket, spigot on the side, you open that spigot and water starts to flow out. The premium dollars, that's going to represent the water. So as long as there's some water or premiums left or cash value in that policy, upon the death of the insured, that policy will pay out. So it's very important that you adequately manage in these variable policies those asset allocations, so we're growing that in an efficient manner, but also mitigating some of that risk. And then on the other side, the spigot, so to speak, you're going to have policy expenses. All of those things listed there are going to be deducted on a monthly basis. So it certainly it can be a challenge to manage a lot of the assets in these variable policies. And Eric, what are some of the challenges that trustees face on these variable policies?
Thank you, Tony. That's an excellent question. First, a lot of these variable universal life policies were sold in the late 90s and early 2000s, projecting at a higher earnings rate, such as 10 or 12%. In many cases, the as-sold earnings rates have not been achieved. An item of note, and Tony, you briefly touched on this, is the design of VUL policies basically move the investment risk from the carriers to the individual policy owners. The next item of importance is sub-accounts that are offered are product dependent. Different VUL products with the same carrier can have materially different sub-account offerings. Our team has made allocation recommendations for products with as few as 10 sub-accounts, and we also have made recommendations with products with over 120 sub-accounts. So there is a vast difference in the amount of sub-accounts that can be offered within a particular policy. The next item that's a challenge for policy owners is the fixed account allocation. Typically, carriers limit transfers from the fixed account to 10 to 25% of the value allocated to that account on an annual basis. So our recommendation is typically to only use this account when you're minimally funding the policy, unless that fixed account has an above average crediting rate associated with it. Another challenge is the money market sub-account. We have uncovered variable policies that were invested only in the money market account for an extended period. In these cases, that policy could not meet the desired performance over an extended period. It's just not going to achieve the investment returns over the life of that insurance policy. Overall, with variable policies, they do pose significant risks to the policy owners and to fiduciaries. That includes policy lapses due to underperformance, lack of consistency in allocations, and lack of consistency in documented process, along with grantors directing the investment allocations.
Yeah, thank you, Eric. Certainly a lot of challenges there, and you mentioned kind of misuse or misuse of fixed accounts or incorrect allocations. At Life Insurance Trust Company, managing over 7,000 policies, we certainly have experienced a lot of that. We've had multiple circumstances where allocations have been completely inaccurate or completely avoided when they came over to us, and we've had to fix a lot of those. You mentioned money market. We had one grantor in particular that when policy came over to us was underperformed based off illustrations that were there, and turns out it was in a money market for over 15 years, where during that time period, interest rates were at historic lows. So we had to come in and correct that and get it fixed it. But ultimately, the grantor had to put some more money in to project the policy out a little bit further. And a lot of it is kind of educating these grantors and not letting them direct those investments as well. I agree. It's certainly an important thing that, as trustee, you're fully responsible, and while grantors can provide some input, the ultimate responsibility is on these trustees. So it's very important that we have a good process. What's some of your process that you have on these accounts, investing these variable policies?
Yeah, first off, Tony, our recommendation is to set up a policy review process. It's very important to analyze the characteristics of each policy. You need to understand if that policy is adequately funded, has any policy loans, is with a financially secure carrier. When evaluating variable universal life policy, our team collects illustrations at current funding, zero pay, minimum funding to mature scenarios, and our preferred rates are at a 6% and an 8% gross earning rates. These illustrations at these rates will provide the information needed to assess any policy issues. These funding scenarios will indicate the annualized premium amount needed for that policy to stay in force for the desired length. It also allows for detailed conversations that you can have with the grantors regarding the funding of those life insurance policies. And finally, any report needs to provide life expectancies of the insured or joint insureds. That's a very important factor that needs to be identified in the review process, as it is a key piece of the decision-making process when it comes to asset allocations.
Wonderful. Thank you, Eric. Yeah, that's certainly important. Eric, how do you, select, when you're, certainly that allocation process is important. Can you tell a little bit about, once you have the allocations, how do you go about actually picking the funds? A lot of these can be, like you mentioned earlier, a little bit overwhelming. And how do you go about that?
Hey, first off, Tony, our recommendation is to establish an asset allocation model. The models that we have in place for our clients typically include 5 different asset allocations ranging from aggressive, then you have moderately aggressive, moderate, moderately conservative, and conservative. These models have the breakdown of allocations, the different domestic capitalizations, your foreign funds, your emerging market, your specialties such as real estate and fixed income, and then your different bond funds, your domestic investment grade, foreign, and high yield. Currently, our aggressive model, has about an 86% equity and 14% fixed income mix, whereas our conservative model has about a 40% equity, 60% fixed income mix for investing in variable life insurance policies. The items that define the model that we select are based upon the policy's time horizon, which is the life expectancy of the insured, and the policy's funding adequacy. So those are our decision points. A difficulty with a VUL is cost of insurance increase as the insured ages. So once an insured is in their 90s, COIs are extremely high. This makes the importance of policy performance in the early years when the insured is younger very important. If a decision is being made to minimally fund a policy just to cover the cost of insurance, our recommendation is always going to be just the fixed account to take all the investment risk associated with that policy away. It is another item that it's very important is to understand the requirements associated with death benefit guarantees. As in some policies, investments are restricted to a few different sub-accounts. There's certain allocations that can be made to your more aggressive that are very limited. So it's very important to understand the allocation requirements to ensure that death benefit guarantee remains in effect.
Certainly a lot to think about. What are some things you look at on those individual fund bases? So we have the allocation there. How do you actually pick these funds?
Yeah, absolutely. When we're looking at the different funds, the first thing we do is identify all the sub-accounts that are available within a policy. Next, our team classifies each of those sub-accounts. We're looking to classify them as large cap growth, large cap blend, large cap value, your different mid cap, your different small caps, your different foreign funds, your diversified emerging market, your specialty funds, your technology, utilities, real estate, and your different fixed income funds. Next, the items that we look at, first we look at performance. We look at 1 year, 3 year, 5 year, 10 year performance, along with the management tenure, just to ensure we want to see how reliable that performance has been associated with the manager tenure. Next, we're going to look at expense ratios and factor those into our decision-making process. Next, it's going to be risk considerations. We're going to look at the standard deviation of that sub-account. What's the beta associated with that sub-account? What's the alpha on that sub-account? What's the Sharpe ratio associated with that sub-account? And then as we begin to select our funds, we're going to start to really look at the underlying composition, the domestic versus foreign, the equity versus fixed income, and then we're going to look at the capitalizations of those funds, how much is actually in large cap value and large cap blend, large cap growth, your different mid caps and your different small caps. The importance of that is we want to really ensure that the composition of those sub-accounts meets our classification of that sub-account. And next, as we make our selections, we're looking at correlation coefficients to see how correlated the subaccounts we have selected are. And then from our selection, we start to put percentages based upon the asset allocation model and risk characteristics that we want.
Wow, certainly a lot to think about there. And I know at the Life Insurance Trust Company, one thing we're very careful of is having a very consistent, concise process in doing that. And it's very important to have that in place. One thing that you want to be very careful of is not classifying, doing one thing here and then having another strategy over here. These are a lot longer term focused asset classes, and And certainly as a trustee, you have to have a very defined process that takes all of the things that you just talked about into consideration there, Eric. And Greg, what are some real key takeaways that you would have from this conversation here?
Yeah, and Tony, one question that I'm seeing pop up here before I get into the key takeaways is you got your process, you're following it, you just have that grantor that wants to tell you how to invest those assets. I know you briefly touched on that before. What do you do when someone says, "Hey, I want 100% in the S&P 500 index," and let's say
Yeah,
they're 80 years old or something?
yeah, great question, Greg, and not an uncommon one actually. We have a lot of grantors that want to control the investments, and as I mentioned earlier, when these are in irrevocable life insurance trusts with the key to get out of the estate and not have the grantor retain any incidents of ownership. I think there's a couple ways that we can handle that we handle it over here. And, we have made some accommodations, but one key thing is beneficiary involvement. We have to have beneficiaries sign off if we're going to have some type of different allocation, along with indemnification language, protecting us as trustee if we're deviating from our process. A lot of that is really educating clients too. A lot of people may think they want this allocation, but after we, loop in people like Eric and go through our process and why we do it and the diversification and things of that nature, a lot of people actually want us to do it in the end. But certainly I would say, Greg, the biggest thing is to have that beneficiary sign off. All parties of the trust sign that, along with indemnification for the trustee.
Yeah. I mean, I think as everyone can see that this stuff is complicated. It takes a little bit additional time versus a traditional universal life policy or a whole life policy. We conducted a fee survey last year, and 90% of organizations are not charging any additional fees to manage variable life insurance. And we highly recommend you should add it to your fee schedules, an additional $300 to $500 to manage a variable. We see regulators coming into organizations now. Not only are you doing that policy review, but if it's a variable, what's your process for managing that asset allocation? Takes additional time. Certainly need to get those processes implemented. Key takeaways, it all starts with that annual review. Is the policy projected to lapse? Is it going to carry well beyond the insured's life expectancy? Is it with a good performing insurance company? Suitability updates, is the policy still needed? Do they still have an ability and willingness to pay the premium? And have there been any health issues? That kind of goes into time horizon, which is a component of the asset allocation process. If you have somebody that's had a significant health issue, perhaps you want to plan for a shorter time investment horizon than an insured that's going on 5-mile runs every day. You get the review completed, periodically get those suitability updates, get your consistent asset allocation process, as Tony mentioned. Make sure you're consistent across the board, that you're not treating one policy different from another policy, but you stick to the process. And that kind of goes into managing these policies as a long-term investment. Nobody can time the markets. They go up, they go down. No need to pull all the money into a fixed account if the market's going down. Look at your asset allocation process. Are you within those corridors, that equity to fixed income mix? And then keep clients informed. I think that's really important as well, and that's a key takeaway as well. Keeping them informed could help ensure that there's no surprises. Letting them know the performance of the cash value within the variable. It may overperform, it may underperform. They may need to throw more money into it. Perhaps they don't need to throw as much money as they originally thought into it if the investments outperform the initial projection. So keeping clients informed, I think, is a pretty important takeaway as well. With that said, we do have some questions here. Eric, this one might be for you. How do carriers typically account for mortality and expense charges within their statements?
Yeah, typically what we see those accounted for is within quarterly statements. What they typically do with M&E type expenses is they're going to take those pro rata from the different sub accounts that you have invested in. So, and the statement's going to define the specific charges that were taken from that specific sub account.
And another one here, can you comment on the restrictions that you see when you're moving cash around? I know some of these policies, you may be limited how much money you can pull in and out of certain funds.
Yeah, the one that really restricts investment transactions is the fixed account. And typically what we see is 10 to 25% can be taken out on an annual basis. That's pretty typical. Some of these policies restrict the transfer to be around 30 to 60 days within the policy anniversary. Overall, what they're trying to do with that fixed account is to ensure that that crediting rate they have in place, that they don't have a massive transfer out of funds, so that they can ensure that that crediting rate is achieved.
Thanks for that, Eric. Another one for you. Does a policy with a death benefit guarantee change the model you select?
It can, based upon the requirements associated with that death benefit guarantee. We do have policies such as John Hancock that they limit it to 13 allocation funds. So we have to select from those allocation funds. So we may not be able to exactly match the desired asset allocation. If you need to be overly aggressive, we might not be able to find the funds to get that same equity fixed income mix as is desired by the model.
Great. Well, thanks for everyone's time today. We are just under that 30-minute kind of desired time frame. Hope you all have a great rest of the afternoon, and thanks for joining us, and continue to see what topics we're going to be having available on Trust Ed University. Thank you.